Hi, this is Jin Rong, Market Strategist for IG Singapore. Wall Street followed through with its risk rally last week, tapping on a series of robust corporate earnings while continuing to price for impending rate cuts from the Fed despite some hawkishness from US policymakers. All three major US indices managed to deliver fresh record highs, notably with the S&P 500 flirting with its key 5,000 level. The new week may offer Chinese equity some much needed break from its current gloom in light of the upcoming Chinese New Year holidays. The US earnings season may see some toning down, but nevertheless, a series of economic data will remain on watch to move the dial around rate cut expectations for global central banks. Heading into the new week, here are 4 things on our radar. First up, with much of the big tech earnings behind us, the US earnings season may tone down a head, but nevertheless, several notable releases will remain on watch, such as Airbnb, Robinhood, Dropbox, and Coinbase. Thus far, corporate earnings momentum has been robust. 66% of S&P 500 companies have released their results, with 81% delivering an earnings beat. This rate of outperformance towers above both the 5-year and 10-year average. Next up, we have US CPI data out on Tuesday. A strong run-up in US economic data over the past weeks have put a March rate cut off the table, with the odds of a March rate cut shrinking to a mere 16% compared to the 63% priced just a month ago. Ahead, markets will be keeping a close eye on whether stronger economic conditions will hinder the Fed's inflation fight. Thus far, policymakers have stuck to their cautious stand, indicating that they are in no rush to cut rates and further inflation progress will be needed to challenge that. Expectations are for US headline inflation to come in at 2.9% year-on-year versus the previous 3.4%, while the core aspect may ease to 3.7% from previous 3.9%. Next, we have the UK inflation data out on Wednesday. UK January headline inflation rate rose for the first time in 10 months, which may explain the slight hawkishness coming from the Bank of England last month. Further lack of progress on the inflation front may lead policymakers to stick to their stance that monetary policies will need to remain restrictive for some time and could further dampen hopes of imminent rate cuts. Lastly, we have Japan's preliminary 4th quarter GDP out on Thursday. Conditions are set for a modest bounce of 1.4% in the 4th quarter versus the 2.9% contraction seen in 3rd quarter 2023. Over the past year, Japanese policymakers have been mulling the possibility of an end to its negative interest rate policies, with an exit timeline still being muddled thus far. With that, any weaker than expected GDP number next week may fail to provide much conviction that conditions are ready for a raise in policy rate, and that may preclude Japanese policymakers from delivering any major policy changes in its March meeting. That's all for now, and I will see you next week.